Hello, everybody. Welcome to the webinar on private equity valuation in the 2020 market. Thank you, Nicola, for making this all happen, and warm welcome to all of you. Before we start the presentation, which will be a series of slides, which we're going to talk through, just a couple of words about myself. So I work as the private equity specialist trainer for LEORON. But my main profession is that I'm a private equity fund manager. I've been a private equity fund manager for about 20 years, having managed 3 different funds and working in private equity in Central Europe, the Middle East, and Africa primarily. So that's my professional background as a private equity fund manager. So turning to the talk, we'll have some Q&A at the end of the talk. So feel free to drop in any questions you want into the questions pane that you should have. So let me start without further ado, and a few thoughts about the current corona pandemic. And obviously, it's something that we are all talking about a lot because we're all living through it. It's something that's affected everybody pretty much everywhere. And so what comes natural is clearly to compare what we're going through now as a crisis with recent or past economic crises. And this is quite relevant in private equity because we have the I should say not the benefit, but we have the experience of a crisis that was not so long ago, which was in 2009, and so it comes natural to compare it. And so I'll talk a little bit about that, but clearly, what are the main differences between the crisis of 2009 and today? That this crisis is an act of God. In 2009, it was man-made. It was a financial crisis, and so the two phenomena are very, very different from each other. 2009 was a financial crisis. 2020 is an economic crisis created by a sudden drop in demand and disruption of multiple sectors. And the question everybody's asking themselves, which I'll be discussing, is when there is a recovery, what kind of form is it going to take? Is it going to be a V-shaped recovery, so a bounce back fairly quickly, or is it going to be a U-shaped recovery where we stay at the bottom for some while before we move back upwards? And these are all going to be things that are going to impact valuations in the private equity market. So I'm going to talk firstly about the environment today. So what valuations of companies right now in private equity are looking like, and what we can expect for this year. And that also will relate to how private equity managers are deal making, and it will also relate to private equity fund managers' management of their existing portfolios. And then I'm going to turn to talk a little bit about how we actually value a company, a troubled company, in a little bit more depth in terms of a methodology for valuation. I should just mention that before I was a private equity fund manager, which I've been for the last 20 years, I did work for 5 years as an administrator of troubled companies, so a court-appointed administrator of companies in difficulty, where I specialized in companies where there were serious problems. So that was some experience that was quite useful when it comes to for the current crisis that we see today. So let's start by, before we dive into the private equity market, let's take a look at the public markets. And so this is where we will try and connect the private equity in the context of the wider macroeconomic environment. So I've tried to summarize it in one very short slide, because I'm obviously a private equity expert. I'm not a public markets expert, but the two are connected. So if we look at this this slide here, and if you look at the top left, we can see the performance of various stock market indices since last year. And so what we can see is there was this drop in March, and then a market recovery of the stock market indices, and everybody's wondering now which way the market is heading. Many stock market experts are suggesting the market is overvalued and another serious decline is on the way. These are all things that are being debated very accurately and very intensely these days. If we look at the second chart, the one on the top right, we can see the effect of the intervention of central banks into the economy. So the liquidity that central banks have put into the economy by releasing funds. And it's interesting to compare the release of funds in 2020 and compare it to 2009, and you can see on what a huge scale that is, and that is in fact true, because if we think back to 2009, we can remember that the authorities, so governments, central banks, were struggling with what to do during the economic crisis of 2009, and one of the features of this pandemic in 2020 is that as a result of measures that were put into place in 2009, governments were much quicker to react in terms of taking measures to try and cushion some of the negative effects of the current pandemic. Although many people are questioning and wondering what will happen if there is a second spike in infections later this year. But clearly there is a correlation between the liquidity injection that the central banks made and the rally in the markets. However, you know, it's not all rosy. If we look at the bottom left-hand chart, you can see this is a chart of how the share prices have moved since the 23rd of March, which was the low point in the stock markets this year in 2020. And that's the top in darker blue. And if we look at the bottom in lighter blue, it shows the changes in forecast earnings per share by analysts. So what we can see is that since the bottoming out in 2000 on the 23rd of March, prices have come back, which we know, but forecast earnings have gone down. So that would suggest that there is something's going to have to give at some point in the future. If we then turn to the table at the bottom and on the bottom, in the middle, on the right, we can compare the forecast. The IMF, these are from the IMF. We compare the forecast made in 2009 to the forecast being made today. So, for example, if we take the example of Italy on the top, you can see that in 2009 there was a forecast. At that time, they were forecasting a decline in their GDP of something like the figure that you see there. And then if you look at the forecast, which is the one in the red or the light red, the forecast for 2020, you can see that these are significantly worse than it was the case in 2009, which is suggesting that there is going to be some kind of storm waiting for us as we move away from the kind of lockdown freezing into the real effects working themselves into the economy through unemployment and declines of certain sectors. So the macroeconomic picture is certainly looking fairly negative. And if you look, finally, if we look at the chart at the bottom right of the slide, it shows the sentiment in the indices for various jurisdictions, the Eurozone, US, and China, compared to the sentiments at the time in 2009. So we can see it's fairly comparable to 2009, that the sentiment, economic sentiment is fairly negative. So what it all seems to be pointed towards on the public market side is that there was some holding on where people were perhaps not sure what was going to happen. There was a rally perhaps triggered by liquidity measures, but certainly now the outlook for the economic effect is fairly bleak and expected to be fairly negative for the public markets. And it's in this context that we should try and look at the private valuations. So having looked at the public markets, let's take a look at private equity markets and try and make some sense of what we have seen so far. And so my starting point is a study that was done by a very major private equity LP, so a major institutional investor that invests in many private equity fund managers. And they made a study which they completed by coincidence last year, and they were studying the effect of economic crisis on private equities. And this study was done over the period of 1994 to 2019. And so in that we would capture the crisis of 2000, we would capture the crisis of 2009, and we would capture some other cyclical negative movements. And this study showed that there was a slowdown in transactions. So firstly, before 2009, the average holding period of private equity investments, so the period for which fund managers were holding their investments, was approximately 3.7 years, so something like 4 years. So from the moment the private equity fund invested to the moment the private equity fund sold his investment, 3.7 years would pass. And they found in their study that following the crisis of 2009, this average holding period increased by over 2 years, in this case 2.5 years. And so the effect of the crisis of 2009 was to increase the holding period, in other words, to slow down the exits private equity funds would be able to make. And this is the first thing we should expect to happen as a result of the 2020 crisis, based upon some of the lessons of 2009. Let's go on to the second important conclusion that this study showed. The experience was that the private equity investments that are currently made experienced a decline, as you might imagine, along with any type of investment. But the investments in the private equity portfolios were lagging the declines in public markets by approximately 1/4. So as the public markets fell, the private market investments would reflect that fall, but with a delay of about 1/4 or 3 months. So that's something we know from the previous experience. So we should expect something like that in the current environment. So the private equity market declines will be lagging those of the public markets. And finally, the third important lesson that came out of this study was that the declines in private equity portfolios in the 2009 crisis were about half of that of public equities. So the private equity companies lost, the value losses in private equities was about half that of public equities. So what does that point to? As an expectation we can have based upon something that is, let's say, a solid study rather than just on our emotions, because a lot of people are, giving opinions based on emotions these days. Based on the study, we should expect private equity investments to become held in the portfolios longer by companies. We should expect the decline in their value to be lagging that of public markets, and the decline to be attenuated compared to the public market. So these are all, broadly speaking, certainly the third one, the decline being half of public equities, is certainly a good thing, relatively. It's not as much as public equities. So those are some of the things we might expect based upon studies made which were done on a rigorous basis. So let's now turn away from the study and what we could expect to what we can actually see in the market. Now, all we can really see is, we're now in May 2020. The crisis really started in February. It's just been 2-3 months of data. That's not a lot. So we've seen mostly signals in the market. We've seen articles. We've seen people making announcements. We've seen many announcements by some of the larger private equity funds who tend to have a more public presence, which are suggesting some announcements which are suggesting that the portfolios they have are going to be cut down by something like down by about 10% to 25%. There've been announcements by various firms such as KKR and Apollo and Carlyle. Others they've been pieces of information that have been announced, and the ranges have always been have been in sort of 10 to 25% declines in the portfolio. Some discussions I've had with mid-market GPs and fund managers are suggesting that the multiple EBITDA multiples of deals have fallen by 40, 50%, but that's been very limited information, because the fact is that most of the deals have been frozen, for the last couple of months. Coming into in terms of the data, I apologize. There's a typo there in the slide. The quarter one data, most private equity portfolio net asset value data, which is released by private equity funds about the value of their portfolios, is usually released on a quarterly basis. And so we've had the releases of the end of March data, but this is a bit too soon to really get a picture of the impact. And so most people in the market are going to be looking for the second quarter data, so the data in the market as of the 30th of June, as the strongest indicator of what we might be seeing. So we have to be waiting for the data to get more hard data, because it's only been a couple of months, 2-3 months since the crisis started. Everybody is kind of waiting for the data as of the 30th of June. So we have to wait for that to get some more hard evidence of the effect of the crisis. But I think we've got already some reasonable expectations we could have that we might be looking at declines in the portfolios. At the moment, it's 10 to 25%. Some may be more, some may be less. Let me say a few words about the effect of how deal making is proceeding in the private equity market right now. What we've seen is in 2019, there was a lot of fundraising that took place. And so, in other words, there's many funds who were lucky enough to raise their funds in 2019. There were several funds raised in the beginning of this year, but those were not new fundraisings from 2020. It was more things that were going on in 2019 that just technically closed in 2020. So there's a lot of funds that have substantial amount of capital. And one thing always to remember, never forget, that there's about worldwide, there's about 8,000 private equity firms worldwide, but always remember that about the top 20 to 50 firms account for half of the capital. So these mega funds like Carlyle, KKR, Blackstone and others, these mega firms who number about some tens of firms, account for half of the money, and then the rest of the money is shared by 7,950 mid-cap firms. So we do have two different markets we have to consider, because the mid-cap market is the biggest market by number of deals and is also much more significant, for example, in emerging markets. So in terms of deal making, we have the buyout funds have a lot of what's called dry powder. In other words, they have capital committed, but they have not deployed this capital. And the deals we have seen this year have either been residual deals from last year, or the ones we have seen that have been, let's say, fresh deals for 2020 have mostly been debt deals, particularly involving the larger buyout funds who've been lending, sometimes lending money to their own portfolio companies, or purchasing debt at a discount from other investors or other buyout funds, in fact. And so there is very limited in terms of fresh new equity type deals actually going on right now. When it comes to the mid-cap market, so the mid-cap market, we're talking about fund sizes of up to, say, 1 billion or something a bit more than that, and deal sizes accordingly. The mid-cap equity market has been pretty much frozen, with almost no deals going on, because on the one hand, the owners of companies who might be interested in receiving private equity are waiting to see what happens, so that they're not selling, whereas the buyers who have revised their expectations downwards to buy more cheaply are not able to buy because the sellers are not moving. And so we should expect the market to be frozen. And this, let's say, this kind of psychological block usually lasts some months until sellers adjust their attitudes, either maybe because their financial situation changes or becomes more difficult over time. So what we should expect starting in the second half of this year is an eventual strategy of buying and building of companies with weaker ownerships. such as family or founder companies who don't have the financial resources to put back into their companies. So we should expect deals in the mid-cap market to start probably towards the last quarter of this year, but not before that. The other thing we should expect in deal making is secondary deals. So this means a secondary deal means an investor in a private equity fund or wishes to leave his position in the private equity fund is replaced by another investor. These are known as secondary deals. And so what we should expect is we may see some activity in secondaries deals where there's going to be a reshuffle of some of the portfolios by LPs to start in the second half of 2020. And so everybody's kind of waiting for the second quarter valuations before taking stock. So assuming the second quarter valuations, meaning the 30th of June, will start to become released in July, then August we obviously have the holiday period, which means really September is really the first time we're going to start seeing some kind of movement in terms of deal making in 2020. What about how are private equity investors managing their investments? So let's move on to talking about deal making, which we've seen, to what private equity are doing to manage their existing investments. Well, firstly, how are they approaching their companies? Well, it's just been a couple of months, so it's still too soon to really see the long-term decisions about the portfolio. But what we're seeing now is staff protection. So the private equity owners are making sure that the staff of the companies are protected and working from home and doing what's needed to keep things going. Secondly, liquidity management. The GPs are making sure that their portfolio companies are not running into liquidity problems, and they'll be assisting them either through assisting management, providing them with funding perhaps, or arranging funding. So we're seeing liquidity management. And the third main intervention that we're seeing on portfolio companies is supply chain and market impact assessment. So supply chain assessment means the GPs are looking at their portfolio companies and saying, okay, what's going on with your supply chain? Has it been interrupted? Are the suppliers asking for cash on delivery, or are they still extending credit? What's happening on the other end with customers? Are customers paying? Should we be rethinking about going to some other customers? And so on and so forth. So, and then market impact, the GPs are looking at, what parts of the market their portfolio companies are having difficulty with, and maybe they should be concentrating on other markets. So that's what's going on in terms of the management of the portfolio. What are the GPs doing? Well, the GPs are doing some cash injections to their portfolio. Sometimes they're doing debt buybacks. And one of the advantages for the bigger buyout funds is that many of the debts held or leverage held by their portfolio companies since 2015 have had fairly soft conditions because of a fairly buoyant financing market, leverage finance market. And so the companies are not fairly heavily penalized in terms of loan covenants, and that gives them a little bit more breathing room vis-a-vis the banks and the providers of leverage. And so what we could summarize the interventions of GPs today is that there is a boosting of operational support, but not yet restructuring. And there is a very big difference between operational support and restructuring. Restructuring means permanent changes, it means changing management, it means more dramatic kinds of decisions, and that is still yet to come. It may come later this year. And finally, the fourth and last thing that we should not neglect is in terms of venture. And so in terms of venture capital and startups and early stage companies, we should expect a triage of the weaker companies. In other words, a venture fund which has a portfolio of startups and early stage companies is probably going to take a long, hard look at its portfolio, and the chances are, if there's a couple of weaker companies, they're more likely to kill or liquidate those companies than they would be in 2019, because resources have to be prioritized. So we can expect it to be a difficult environment for startups which are on the weak side. The chances are a much larger proportion of them will not survive. So that is some thoughts about how private equity investors are managing their portfolio in today's market. So, so this is, there's a question, will we be able to get a version of the presentation from Saqib Sultab? Hi, Saqib. Yes, you will be able to get a copy, so you don't have to write it all down. And so that's fine. Everybody will be getting a copy of this presentation. So I've kind of outlined the current market and how it looks. You know, it's only been 2 months, but we have the benefit of 2 months of data. We have the benefits of a past crisis of 2019 that can give us some ideas of what we should expect. And the last thing I should mention, which I think is always worth mentioning, is that one of the advantages we have in private equity is that we have many fund managers who lived through the 2009 crisis, and those fund managers who have lived through that crisis in 2009 are much better equipped to cope with the current crisis in 2020, although it still will be quite different. But that is an important resource that we have that. And so fund managers who are maybe newer to the market, who haven't had the benefit of living through that crisis, may be in a weaker position. Okay, so talking about how we deal with a company valuation in a market such as this one. And this is where I draw upon my previous experience as a bankruptcy administrator, where I worked on companies that had dramatic different types of problems. And so what we are going to be doing, whether it's a virus or other causes, we are dealing with companies that are going to be in decline, which means that the demand from their customers is reducing. And we're also going to be dealing with companies in distress, which means the company is in trouble. And so these are two different concepts, which I will explain in a second. So the first questions we have to ask ourselves when we want to value a company in this current context, assuming this company is not doing is in some difficulty, which many companies today are. There's two main questions we ask ourselves, which help us to figure out how to value these companies. The first question is the decline of the company reversible or permanent? So, you know, what would be an example of that? Well, an example could be, let's say I'm in Vienna right now. There's a well-known restaurant down the road which is just reopening. Is the decline reversible or permanent? In the case of a famous restaurant, it's probably reversible because you know, once people are coming out of lockdown, they're going to go back to that. They're going to go back to that restaurant, and so the decline is reversible. We might take another example of a permanent decline. This could be, for example, you know, some industry which has been changed forever by corona, some kind of medical industry which may face a permanent decline. It could be some kind of shops where people move on to you know, home shopping or Amazon, for example. So is the decline reversible or permanent? And the second question is, does the firm face a serious chance of distress? Distress simply means the company has problems with cash. So distress means you can't pay the salaries, you can't pay suppliers, you're insolvent. And so those are the questions we have to ask. Those are the two key questions we need to ask in order to understand how we can value and deal with a company in trouble. What is restructuring? Let's define what we mean by restructuring, because we may get to a position where we need to do restructuring. And a restructuring simply means that we reach an agreement, the company is in difficulty, and something has to be done. And it means the company in its present form cannot survive with the status quo. It will simply go bankrupt one way or the other. And so the restructuring is a way to avoid that, to avoid liquidation or bankruptcy. And a restructuring simply means we reach an agreement between the company, its creditors, and some of its stakeholders. So that means, who does that involve then in practice? That means the banks who the company has debts to. It can mean the suppliers towards whom the company has trade debts. It means the government to whom the company may owe taxes. It means the employees to whom the company may owe salaries. It means the management, who also have to be involved in it, who have their position to consider, and it means the shareholders, who are the owners of the company. So we can see that there's different stakeholders who are involved in a restructuring who have different interests. So for example, you may have a bank who has a senior secured loan which has collateral attached to it, and that bank may be much happier for the company to go bankrupt because that bank can go and take the land and the buildings. Whereas we may get a mezzanine provider who has an unsecured loan who wants the company to continue. And these are things that have to be reconciled in a restructuring. There'll be different interests between unsecured creditors, secured creditors, employees, the taxman, and others. In terms of negotiation, these will tend to involve only not all of the creditors because that would be too complicated, but most negotiations will always involve shareholders and the management of the company. And so that's what a restructuring is. It's an agreement between people to keep the company going. What do we need in order to restructure a company? Firstly, we need to have a viable business. So the business has to actually be financially viable. So in other words, once the storm or the crisis has passed, that business needs to have to still be able to exist. People still need to take planes, or people still need to go to the restaurant. There has to be a viable business. That's condition number one. Condition number two is that a sufficient number of the key stakeholders must support the restructuring. If I'm a restructurer, I used to be a restructuring expert, and I would have these negotiations. I would have the management, I would have trade unions in the room, I would have the employees, I would have some shareholders, I would have some banks, I would have the government, and it's very complicated to make all these people agree amongst each other. And so we need to have a sufficient number of key stakeholders who would support a process of restructuring. That's condition number two. And condition number three is that the company has to be able to continue to work until the restructure. So the company must not be shut down. People must still be selling the products or services, and people must be still going into work. And the stakeholders must be able to work with the management. So we also have to assume that people are able to work with the management and things haven't got deteriorated so much that it's impossible for them to work together or for example, to sit in the same room together. What are the options I have when I'm restructuring? So there's two options. One is a consensual option, which means everybody agrees, and the other option is a non-consensual restructuring. So the consensual option means everybody agrees. So what can happen in a restructuring? Well, one thing can be there could be a waiving of debt covenants. So the bank would say, well, okay, we're just gonna leave the fact that you couldn't make the interest payment. We're not going to foreclose. So we're just going to act as if everything is okay. We're going to do a standstill. Another option could be refinancing, that the company refinances some of its debt with somebody else on different conditions and gets rid of one of the other creditors. Another thing could be a simple reduction in the debt, so-called haircut. So if the bank is owed 100, the agreement says the bank will just agree to get repaid 60 instead of 100. Takes what's known as a haircut on their debt. And that's quite common in restructurings. The fourth thing that could happen is an equity injection by the shareholders, either the existing shareholders or new shareholders, and it could be a combination of all of the above. So a restructure might be a combination of debt covenant waiving, refinancing, a haircut on debt, and equity injections. And these can all come into one single package in a restructuring. And if the consensual doesn't work, we would then move on to non-consensual restructuring, which would usually fall under the court, a court-appointed type administrator who would do a procedure known as, in the UK as administration, known in the US as Chapter 11, or some variation of that. So what does this mean for valuation? Well, when we want to now try and value a company, if we want to value a company that's in difficulty, which is going to be the case in 2020, we have the x-axis is decline, and the y-axis is distress. And so what we have to do is we look at the company and we can put it into four potential categories, which I show here. And according to which of the four categories the company falls into, we then apply a valuation methodology, which will be different for each of the four categories. And what we are looking at here, most commonly, in terms of the companies that I've looked at in the last couple of months, the current scenario in 2020, in May 2020, is mostly reversible decline combined with distress. In other words, the companies, they have no reason to disappear because one day they will be able to get customers back, but they're in distress because of cash flow problems and liquidity problems. So many companies will fall into the category, the bottom left-hand category of reversible decline with distress. We have some companies that may go into irreversible decline, which means that the world has changed so much in these months that these companies no longer are viable companies because the customers simply don't exist anymore. But it's far too soon to tell who is going into irreversible decline. At the moment, it's all looking more like reversible decline because it's too soon to say. Obviously, there has been a big disruption to sectors. So clearly, we see the growth of, for example, of Amazon and the decline of going to the shop. These are all things we can all work out ourselves, but it's far too soon to tell what's going to be the medium-term effect and for what industries the pandemic will prove to be an opportunity, and for what industries it will prove to be their end. It's too soon to tell, but those entrepreneurs out there who will be able to figure that out in the next few months, they're going to do very well. And those entrepreneurs are going to need fund managers to find those entrepreneurs and to support those entrepreneurs. So that's something we can expect to happen, starting from 2021, when things are clearer, and when we find people who can have the vision to see an opportunity in the current crisis. So what is the effect of distress on operations? And it's important to understand this. Basically, normally when we have a company in distress, it's very difficult to get loan funding from the banks. It tends to dry up, and the main possibility is to receive equity funding from the existing shareholders or new shareholders. Some of the other symptoms of distress is losing customers. Customers will disappear. Accounts receivables become more difficult to collect. So customers think, well, this company is in difficulty. They're distracted. Let's just avoid paying and see if they call us or not. So this becomes more difficult to collect. Suppliers, on the other hand, want to be paid in advance. They insist on tighter payment terms. So that really squeezes working capital. Employees leave, and typically the better employees leave, and the weaker ones stay. So that's another effect. The level of absenteeism increases. People don't show up on Monday mornings. Productivity decreases because people are less motivated, and you get negative publicity. So all these combined as factors, they're really big. They're really tough. If you're managing a company like that, which I did for 5 years, it's a very tough thing to manage and extremely stressful. So what would be the valuation approach we would take? Well, in fact, it coincides very nicely with the private equity approach to valuation, looking at an exit. And so how would we value a company like that? Because we may be valuing a company which is losing money. We may be valuing it so we can't apply a multiple to earnings. We may be valuing a company which has negative equity. So the assets are less than the liabilities. And so in theory, that company is worth zero. But that's not necessarily the case from an accounting point of view, and even trying to multiply it using multiples. But what we would do is apply a private equity approach in which we make an assumption that we inject some capital and that we sell that company in a few years down the road once it's come through to the other side. And these are according to these, let's say, these 4 steps that I show here. And the best way to illustrate that is through an example. I've got a very simple example because I don't want to make this talk too academic. I beg your pardon. Let's assume we have a troubled company, and this company is losing money. It has no cash, very little liquidity. Its accounting equity is zero, so it may have assets of its assets have melted away. So let's assume we have a troubled company and it needs an equity of 6 million, so it needs 6 million euros in order to execute a restructuring plan, which has been developed by, by the management with some help of experts. And these funds would be used for working capital, to improve the working capital, to repay some debt, and to make some investments. So the plan, we make a restructuring plan, and the plan forecasts that in 5 years, the company will make a profit of 3.65 million euros, according to our forecasts. We see that comparable companies are valued at 10 times profits. So in 5 years, if we try and sell the company will be worth 10 times 3.65, which is 36 million euros. So if we injected 6 million into the company and things go as we plan, we can reasonably expect to sell that company for 36 million euros in 5 years from today. However, what we're looking for is to figure out if this company is worth something today. So in 5 years from today, 100% of the company is worth 36.5 million. That still doesn't help me in order to figure out its value today. So let's go on. If I invest 6 million euros and I'm a private equity fund and my target return is 30% on my investment, so I need to earn an annual return of 30% in order to compensate me for the risk I'm taking. And that means that the cost of capital of the company is 30%, interestingly, because in its condition, it has no cost of debt because it can't borrow, and its cost of equity is now the cost at which private equity funds will be willing to advance money as equity. So that's how you work out the cost of equity of a company. So that means that if I invest 6 million today, I need to make in 5 years from today 22 million in order to get 30% a year on my 6 million. So I need to own enough of the company to get 22.3 million when it is sold in 5 years. We've already calculated that 100% of the company is worth 36. So I need to own 61% of that company in order to get the return I'm looking for on my investment. So that means the company today is actually worth 9.84 million euros after my 6 million has gone in, which means, arithmetically speaking, or accounting-wise, that the valuation of the company before my money goes in is 3.84 million. And so that's interesting because the company today has losses and has zero equity, yet it is still worth 3.84 million euros using the private equity turnaround methodology to value the company. So that gives me some interesting insight on how I could possibly value a company. The only other way you could value a company is using option pricing methods, but that tends to be overcomplicated in private equity. That simply means that you would value the equity of the company as a call option on the assets using the debt as a strike price, but that tends to be too complicated and difficult to execute in practice, particularly with privately held companies. So that's how you would approach your valuation. So and I'm sure that that's going to be going on in the second half of this year. So it's all premised upon whether we can execute a restructuring plan and whether we can formulate some sensible forecast for the company down the road in 3 years, 5 years, or more. Which brings us on to the final point, which I'd like to cover, which is, well, if we do that, how do we do that? How do I figure out the value of the company down the road? Well, we would basically use 4 scenarios. We would construct a financial model. So I'm sure that a number of you who are listening to this are very keen on financial modeling. Some of others you a bit less. But we would firstly, in terms of constructing financial models and forecasting, in order to get there in terms of valuation, we need to look at, firstly, is the recovery, are we going to make a scenario of what kind of recovery we're going to make? Clearly, if there's no recovery, there's no point in valuing it because it's zero. But so we would clearly look, is the recovery U-shaped or is it V-shaped? Some other people are talking about the company's value being Nike-shaped, which is a little bit unusual, a bit more unusual. And so we would firstly look at the shape of the recovery that we are talking about. Then, having done that, we would look at what kind of capital injection are we doing? Would it be an equity only injection, or would it be a debt plus equity injection? So you might be able to hypothesize that, okay, I'll inject 6 million to the company, and then in 2 years, when things get better, let's assume we can get some bank debt, some bank debt for further growth. And so do a bit more of an articulation of the modeling that would take place of the capital structure of the company in question, and that's some sort of idea of what approach you could take towards performing your financial modeling. Okay, so we've allocated just around an hour for the talk. So what could I? Let's go into the Q&A. But some of my conclusions would be that firstly, what we should expect in terms of deals is that the deals are going to be frozen for some time. I don't expect much activity until September, and any deals we see are going to be residual deals from 2019 that are still going on. In terms of valuing companies, you need to value them assuming a support package of injection of capital and a restructuring. That would be the approach that I've just suggested. And we should wait for the second quarter valuations in the sector to come out, because that will determine many decisions. The valuations of portfolios in the second quarter will determine many decisions about deal making, about portfolio write-offs, about secondaries, and many other things. So I would suggest that anybody in the business, you would be wise to wait until July to see the second quarter valuations and see how those come out by sector, by region, whether the emerging markets valuations are going to be hit harder than developed markets, and what will be the different hits by sector. And then we should maybe factor in other things, for example, like the oil price and other variables like that. So it's going to be interesting times for 2 months, because remember, it seems to all of us that it's been a lifetime since we've been on lockdown and so much has happened, but it's just been a couple of months and there's still a couple of months to go. So we're in the middle of it in terms of the economic effect. We're in the middle of it, and we have to wait and see a bit longer. Okay, so let's turn it over to your questions. Thank you very much for your patience. Thank you very much for listening. I'm very flattered there's so many of you here listening. Please don't leave yet. I'm going to try and make my answers at least as interesting as my presentation, which I hope you did find interesting. And so let's take it to questions. There's one from Bader. Can you elaborate on irreversible decline? Okay, well, irreversible, let me give you an example of that, which I lived through. There was a company in Italy that made phone boxes. And this was, and what they did is they made phone boxes, and then the mobile phone came along, and people stopped using phone boxes. And they were smart people; they knew it was coming, but there was no way for them to find another use for phone boxes. There was no way for them to change their manufacturing to make a box that was like a phone box for some other use. And there was just no way for them to turn around their business. So their decline was irreversible, because they couldn't reinvent themselves, not because they were stupid, but because there was just no way. So they just broke up their company and closed down. So that's an example of an irreversible decline, that the sector has moved so much, the demand has moved so much, that the company simply has got no viable future. And can we identify companies in irreversible decline in 2020 because of Corona? I think it's too soon. Clearly we've seen some companies like airlines have stopped. Many things have stopped, but we can reasonably assume one day that people start taking planes again. Some airlines have gone into difficulty, but it's probably too soon to tell. But irreversible declines means that it's a shift for the long term in demand, in customers, so that the company is no longer viable. Some companies may be able to reinvent themselves, but to do something else, and some may not, because they just don't have the industrial configuration to do so. I hope that answered your question. Okay, I have a question from Zoya Vdovichenko. Hi, Zoya. Could you please advise what will trigger considering distress in valuation? what's a distress trigger? A trigger, yes, this is something bankruptcy administrators like I used to be would look at. It's one of the triggers is the company insolvent. So does the company have negative equity? So that's a technical test for insolvency. So you would ask the accountants to prepare a balance sheet, and if there is negative equity, that is a trigger. Another trigger would be simply that the company misses a payment, for example, an interest payment on its debt, or is unable to pay employees at the end of the month. So those would be the various triggers that would be an indicator that the company is now officially in distress. I have a question from Vahagan Voxkanyan, or maybe you're from Armenia, I'm not sure. Hello, Vahagan. Do you have an experience to work with distressed asset management funds? Any advice on how their capacities may be utilized? Well, I think the important point to make here is that private equity fund managers have plenty of experience of helping their companies when they're in difficulty through operational support. But the important point is that operational support is something very different from restructuring. And there are many fund managers now out here at the moment talking about raising funds for restructuring, but that is not always a very good idea because the skills to do restructuring are very different from that of a fund manager who's giving some operational support to his company that's facing some headwinds. Doing restructuring, which means dealing with maybe courts and creditors and haircuts, is a very different skill set. And so it's not a skill set you can invent overnight. So I think if you are talking about distress funds, you should make sure those distress funds have been around for a few years and the management team really have the credentials. Okay, let me ask another question. From Marshall Leo, can restructuring be promised and linked to an agreement before the equity purchase or even purchase? Yes, this is what would be known as a pre-packaged restructuring, which is something you often see in administration procedures or Chapter 11, that the trustee, so the person will do what's known as a pre-packaged deal. So he will agree everything with all the different stakeholders, saying if we do this, so if we do an injection, what we'll agree to is a haircut, as other restructuring, and then you go, and then it's called a prepackaged deal. At the moment the equity investment is made, all the pre-agreed restructuring measures are triggered, so we avoid the situation where the equity investor has to put their money in and then negotiate a restructuring, which may put many of them off. So yes. Okay, so I have a question now for there's a question from Ayad Al-Hajj Mohammed. When can you ask my question? Just ask it. I'm just reading through the questions right now. Okay, I'll get to Nurul Hai. What valuation will start to increase sharply then slowly for some markets? Do you assume fundraising activity will increase as well? I assume fundraising activity this year is going to stop completely because it takes some months, so there's going to be very little fundraising. What valuations will increase sharply? Well, that's the million-dollar question. It's hard to say. Intuitively, where people will start to circulate, maybe restaurants will start use, but I think it's hard to say. It's hard to say. It will depend on expectations of the market. Muhammad Ali, key factors to estimate fair value. Well, I think I illustrated that when I talked to the methodology, so I would maybe go through the methodology of the slides you saw later, and you can work through those steps. If you have any questions, please connect to me on LinkedIn, and I will be very happy to do an offline exchange with you. Okay, Bada N, what skills other than analytical and negotiation are required to do this? Well, I think those are some pretty big skills there. I think analytical skills, modeling skills, soft skills to be able to work with people, negotiation skills. These are all skills you would need in private equity. So it's like a multidisciplinary type approach. So think of it as a mixture of hard skills and soft skills. Okay, Paul Babila Bengyala, I'm sorry if I got your name wrong. How can I boost investment to Africa for startups going through the crisis? I think you're probably going to have to wait. Probably looking for some developmental institutions, maybe doing something to kickstart the market, some like AFDB, CDC or others. But in terms of boosting investments, you're probably going to have to wait. It's not going to be a great time for startups in Africa this year. Sorry. Christian Bugabu, can you elaborate on exit options? Well, there's 4 exit options. in private equity is usually selling to a strategic investor, doing an IPO, selling to another private equity fund, or maybe selling to the existing shareholders. I can't elaborate much more than that, but do please attend one of my courses if you wish to get it in much more detail. Question from Aziz Alomaran. In startups, the burn rate is high. How do you reduce the burn rate in this stress situation? Well, I think what you probably should do is you should probably go to your portfolio and do a one-time cull, a one-time clean out of the portfolio right now, of the weaker ones, and that will reduce your burn rate later. It's probably a good time to do that because resources are limited and it's not all will survive. Okay, Saqib Sultab. Saqib is asking one of his portfolio companies. Saqib, maybe you can connect to me on LinkedIn and we could discuss that online because you have a very specific question about one of your own portfolio companies, which we might not have time to cover, but please connect to me on LinkedIn and I will be happy to respond to you in the next couple of days. Ayad Al-Haj Mohammed, temporary closure for some production to re-evaluation. Okay, well, I guess some production lines are temporarily closed. Yes, and it may help you reevaluate the business, but what's going to be more helpful to reevaluate any business right now is to wait for a couple more months of data, probably. Martial Law, what do you think of SoftBank's investment in WeWork? That's a good one. I think it was a pretty bad investment. And I think, I mean, I used to be a bankruptcy administrator, so one of the things I looked immediately was the moral character of the owner. And there have been a lot of question marks about the moral character of the founder of WeWork. So I think that answers the question. M. Warris, how are fund managers making money in the current time? Well, they're not, but they don't feel too sorry for fund managers because at least they have their salaries paid by their investors, so they're not suffering too much themselves. Christian Bugaba, will it be possible to have the presentation? Yes, that will be done. Fahad Al-Busaidi, for private equity, does this mean that firms need to have contingency plans in place to deal with the natural disasters like coronavirus? In theory, yes, but to be realistic, I mean, if you're managing, if you're in Dubai and you're managing a $200 million fund with a team of 10 people, you've probably got a lot of other things you've got to do apart from a contingency plan for a natural disaster. Some may have done it, but the chances are most haven't, and they're just kind of reacting as it happens. That's probably the reality. Paul Babila, I think I've answered a couple of your questions before. The private equity course, can you please make the link available? Yes, LEORON will be in touch with you, Paul, as far as all the details of these courses that I'm showing here. That's not going to be a problem. But so there's I'm doing an online course in June, and then hopefully we can travel again. So I'll be in London in August and Dubai in November. So yes, and that will all be. Oh, and please everybody go to I have a YouTube channel called PE Confidential, which you can search on YouTube, and I have over 150 films and videos all dedicated to private equity, and so you may get, including some further discussion of valuation and of the current pandemic's effect on the industry. So please go and look at my YouTube channel as well after we've listened to this session. Okay, so are there any other questions? Let me see. I see. Okay, so I have another question from Christian. How do you see the future of private equity, short and medium term? Short term, I think it's going to be pretty slow. Medium term, I think it's going to be good. If we saw what happened in 2009, the market was reset at a lower level, but I think the market is going to thrive mainly because of the supply of fund managers who've lived through 2009, and these people are steady hand to take the market forward. So I think in the medium term, it's going to be a good market, but there will be new winners and losers. Muhammad Ali, do you think the insurance services could gain? Off the top of my head, I'm not sure, but please contact me on LinkedIn, and that'll give me enough time to think about that one. I don't want to answer something when I haven't thought about it carefully. Something about from Eduardo Galperin, during the last crisis, many unicorns were created. What types of businesses P are focusing now to invest? I think it's too soon to tell. I think for sure this crisis has been extremely disruptive, particularly because it's been disruptive. Unlike the 2009 crisis, which was a general financial crisis affecting everybody, this crisis has affected some sectors and more than others. So it's a sort of differential crisis across different sectors. So as a fund manager, what I'm really looking forward to doing is I'm looking forward to going and discovering later this year those entrepreneurs who've got the vision to find the new opportunities. So my job as a fund manager is to figure out for myself the new businesses. It's to find the entrepreneurs who've figured it out and to back those entrepreneurs. Okay. Any more questions? Let me just check.
Yes, we still have a little bit more time, guys. If you have any questions, feel free to ask them. Gavin is trying to answer every single question that you're asking. So go ahead.
I'm trying, and you can find me on LinkedIn. So those of you who have a question that's much more detailed, more specific to you, please connect with me on LinkedIn. I'll be happy to accept your request, and then we can exchange some correspondence on LinkedIn. And do check out my YouTube channel for more details and more discussions about this. Okay, let me see. I have a question. What is this is from Ayad Al-Haq. What is the better at the current time, to buy or sell government bonds? To buy or sell government bonds? Well, I guess one of the things that's going on now is a flight to quality, and so many investors are parking their money in government bonds. What we have seen is that we've seen some spread in the yields. So, for example, Italian government bonds, say, for example, compared to German government bonds, have got a wider spread because there's some suggestion that the countries in some countries will be weaker than others. I would definitely recommend buying government bonds of some of these countries like Italy, because in my view it's been overblown. So I would be selective, but yes, it is a good time to put excess liquidity. What would be your advice for investment professionals interested in getting involved in private equity in Africa? Where should we focus? Well, I think it's a small niche market. But I would suggest you go to my YouTube. I haven't got as much time as I'd like, so please go to my YouTube, P Confidential, and there is actually a video dedicated to best ways to secure a job in private equity. So please, and please connect with me on LinkedIn. We can take this conversation further, and please attend one of my courses. Damilola, do you think this current pandemic will definitely have a positive impact on healthcare sector valuation? Well, it depends. On some things, like obviously somebody making masks or disinfectant, they're doing really well. But other things where you had to go to the pharmacy to buy, like some beauty products, they've gone really down, or pedicure's gone really down. So I think it's nuanced. I think it depends. We have to look in more granular detail at the sector to see where it's good and where it's bad. Okay, there's a question from Moaz. What do you think about the promising industry to invest? I think we have to wait and see a couple more months. I would hold on to your money and wait until July and then take a look. And we've also obviously got the oil price to factor in. What do I think about leasing companies are doing in this pandemic? Well, I think probably not. As far as I know, I haven't looked at it in much detail, but I think it's leasing companies tend to depend on companies or individuals wanting to lease equipment, which means that those companies or individuals need to be active economically, which is not the case. So I'm expecting leasing companies to slow down significantly. Damilola Fajemizin, where can we find these new portfolio informations on private equity in July? Well, it depends. I mean, if you work in the industry, you'll have access to your normal channels to the portfolio valuations. If you are simply somebody who's interested in private equity, then you'll find that as the valuations of the second quarter come out, they'll be reported in the financial press and on social media and other places. So I would just keep an eye out. And if you need more detail, you probably have to pay for some kind of subscription service or Bloomberg. So just keep your eyes peeled on the media who will start to report these valuations. Question from Mura. Do you think that many companies benefiting this crisis will be overvalued during 2020? Well, yes. I mean, I think if we're looking at valuations today, we have to wait for the second quarter valuation. So now's not the time to really look at it, except as part of a restructuring plan. Christian Bugabo, any plan to conduct the private equity course in Nairobi, Kenya? I would love to. If there's enough people interested, I'm there. I'll come. So get some friends together, and I'm your man. I'll come. I love Nairobi, by the way. Bada N, can you share training material? Well, I mean, I make a living. I partly make a living as a trainer, so these are my materials. But I do have my YouTube channel, P Confidential, which is entirely for free and which has a huge amount of materials and resources, all for you for free. There's even a free online course in the YouTube channel. It's a kind of light version of my course, which is available for free. And then, obviously, as you understand, if you want to get the full course, you should attend one of my trainings. But do go to my YouTube channel. There's a lot of resources there that are entirely for free, and that's my way to give back to the community. Okay. Any other questions? Well, okay, so we have another one, which is by Vagan. Let's do this last question. Nicola, I'll take this last question. How much should we discount available multiples for relative valuation? That's a tough question. I've seen discounts. I've talked to several GPs in midcap, and they were talking about discounts of 40 to 50% on the multiples, but there's no scientific evidence. We've got 2 months of data. I obviously know a lot of fund managers. I get a lot of intelligence that way, and that's sort of an impression. But even the people telling me these discounts are saying, well, you know, this could change in a month. So I wouldn't rely on that too much. I would wait. We need to wait a bit longer for the second quarter, for the second half results. Okay, Nicola, I'll turn it over to you. I think we've covered most of it, so we can wrap it up perhaps now.